Here's a wild one. Nearly 9 out of 10 professional stock pickers, people paid millions to beat the market, can't beat a boring fund that just buys everything. Over 15 years. Let that sink in for a second. So, should you pick stocks or just buy an index fund? Good news, this one's barely a debate. The data is brutal and it all points one way. Let's look. The dream is simple. Find the next Apple, buy low, sell high, beat everyone. It's a great story, and every year millions of people, plus highly paid fund managers, go chasing it. So how does that actually turn out? Here's 10 grand invested over 30 years. The green line is a plain index fund. It just owns the whole market. The gray lines are active funds, run by experts trying to beat it. Watch. Almost every one of them ends up below. The boring one wins. Why do they lose? Because the market is basically pros trading against other pros and supercomputers. It's close to a zero-sum game. For every genius trade, someone's on the losing end. And after everyone's fees, the average simply has to trail. It's just math. And think about who you're up against when you pick a stock. Firms with billions of dollars, teams of PhDs, algorithms trading in millionths of a second. Versus you on your phone, at lunch. By the time you've read the news, they traded on it hours ago. And even picking a good active fund ahead of time is a nightmare. Last year's top performer is often next year's loser. That past performance doesn't guarantee future results line? Turns out it's painfully true. Hot streaks almost never repeat. Then comes the quiet killer. Fees. An active fund might charge 0.7% a year. An index fund? Around 0.03. Sounds like a rounding error. Watch what that rounding error does over a lifetime. Same money, same returns. The only difference is the fee. The gap starts invisible. Then it grows and grows. By the end, that little fee has quietly eaten a huge chunk of your money. Money that went to the fund instead of to you. Put a real number on it. A 0.7% fee on $100,000 is $700 a year. The index fund? About 30. Same market, same returns. You're just handing over $700 a year for the privilege of usually doing worse. And here's what really stings. The fee is guaranteed. The performance is not. You pay it every year, good markets and bad, whether the manager beats the index or completely faceplants. You take all the risk. They take a cut no matter what. There's a sneaky one too. Active funds buy and sell constantly, and every profitable sale can trigger a tax bill that lands on you. Index funds barely trade, so they barely get taxed. Same return on paper, but you keep more of it. Quietly, over decades, that matters a lot. Now the part that breaks stock picking wide open. The market's entire gain comes from a shockingly small number of companies, and almost nobody can reliably pick them in advance. Here's the data. A landmark study looked at nearly a century of US stocks. The finding? Just 4% of companies created all the net wealth, all of it. The other 96% combined basically matched a savings account. It gets more uncomfortable. Most individual stocks, around 58%, actually did worse than boring treasury bills over their lifetime. The whole market only rose because a few giant winners dragged the average up. Pick one at random, and the odds are not your friend. So picture what stock picking really is. The winners are a tiny handful, buried in thousands of losers. Miss them, and most people do, and your returns fall off a cliff. You don't just need to be smart. You need to be lucky in exactly the right names. Here's the beautiful part. An index fund owns all of them, every company. So you automatically own those rare monster winners, without having to guess which they'll be. You capture the 4% by simply owning the 100%. And you're instantly diversified. One fund can hold 500 companies, or with a total market fund, thousands. If one goes bankrupt, you barely feel it. No single CEO, scandal, or bad quarter can wreck you. Safety, built right in. It's also just easy. Set an automatic buy every month and ignore the headlines. No researching, no hot tips, no 3 a.m. panic. The strategy that wins is also the one that takes the least effort. In finance, that almost never happens. So here are your real odds. Try to beat the market, and history gives you maybe a 1 in 10 shot over the long run. Or just buy the index and match the market almost exactly, basically guaranteed. One of those is a gamble. The other is a sure thing. And before you ask, no, you can't just hop in and out at the right moments either. Miss only the 10 best days over 20 years, and your return roughly gets cut in half. The catch? Those best days usually land right after the scariest ones, when everyone's busy panic selling. One honest warning: the index only works if you actually hold it, especially when it crashes. The biggest destroyer of returns isn't a bad fund. It's a scared human selling at the very bottom. So automate it and try really hard not to look. So what do you do when it crashes? Nothing scary. You just keep buying automatically, right through it. For a long-term investor, a crash isn't a disaster. It's the whole market going on sale. Historically, it's always recovered and pushed on to new highs. Every single time so far. And don't hear the wrong thing. The market as a whole has climbed powerfully over the long run. Investing works. The question was never whether to invest. It's whether you try to outsmart it or just ride it. Riding it wins. Still skeptical? Back in 2007, Warren Buffett bet $1 million that a simple index fund would beat a group of elite hedge funds over 10 years. He won. It wasn't even close. The greatest investor alive says, just buy the index. And this isn't some new internet trick. Jack Bogle launched the first index fund for regular people way back in 1976. Critics called it un-American, guaranteed mediocrity. Almost 50 years later, it's quietly beaten the pros over and over. Boring, proven, and older than most of the folks chasing hot stocks today. Sure, a few investors genuinely beat the market for years, but flip enough coins, and somebody lands 10 heads in a row by pure chance. The problem isn't that nobody wins. It's that you can't reliably pick them beforehand. So don't bet your future on it. Now, if picking stocks sounds fun, and honestly, it can be, go for it. Just do it with a small slice. 5% your fun money. Keep the boring 95% in index funds doing the real work. Scratch the itch without betting the house. And when should you start? Today. Waiting for the perfect moment is its own losing game. Time in the market beats timing it, basically always. And you don't need thousands. Even $50 a month automatically for decades quietly turns into a genuinely serious pile of money. So what do you actually buy? A broad, low-cost index fund. Something tracking the whole US market or the S&P 500. One fund, low fee, done. You can genuinely stop right there and beat most professionals. Want it even more hands-off? A target date fund builds a broad mix for you and automatically gets safer as you near retirement. You buy one thing and basically never touch it. For most people, that's not lazy, it's just smart. Here's the whole game plan. Buy a broad, low-cost index fund. Automate a set amount every month. Reinvest the dividends. Keep fees near zero. And then, the hardest part of all, do nothing. For years. Let it compound. So here's the whole thing in one line. You don't have to beat the market. You just have to be the market. Own everything, pay almost nothing, and wait. Do that, and you'll quietly outperform nearly every expert trying to be clever. Picking stocks feels smart. Owning everything cheaply and waiting actually is. Boring wins. For one money idea, honestly visualized, every week subscribe to Money Visualized.